Very good afternoon to all the members present in this fifth webinar of EEE 6.0 Master Knowledge Series, which is being on the topic SEBI regulations and recent amendments. And to have the opening remarks on the topic, we have with us C.S.B. Narasimhan, our beloved former president of ICSI. Sir, I would like to welcome you on this webinar, and I would like to uh, ask you formally to give your welcome remarks for the session.
Yeah, thank you, Emil, and friends. Good afternoon. It's nice to be amongst all of you, and it's a very, very important topic for the day, which has been chosen, basically on the recent amendments in the SEBI regulations itself. Now, for that, we have none other than Shailashri Bhaskar. She has been a former employee of SEBI, more importantly. But beyond that, she is almost there in all the committees wherever the changes are going to be considered. I recall the meeting when I was the president, we had a committee which was constituted, which was headed by Mr. Mohanty. And at that time, the discussion was how often the changes should happen. Let's understand this. The changes are inevitable as far as the regulations are concerned. It's a dynamic world. The changes will be there and continue to happen. Only thing is, SEBI has now moderated that and has it once or twice in a year. That's basically in about 6 months is the time frame by which they do it. But as a nice practice, SEBI also, you should all know, has a concept paper released based on the discussion held in the committee. The committee which I'm talking about is now currently called the Accolade Committee. That was a committee set up in 2024 by the then chairman, where the discussion was ease of doing business and what are the changes which we need to bring about in various regulations. So that was where. So Shailashri was also there. Interestingly, one of the participant then, one of the company secretaries who was part of the committee, then suggested that possibly there should be not more than 6 months, only in 6 months you should bring about a change. Now that was very difficult to administrate. They felt that it may not be possible because sometimes the needs of the hour would be the change should come out immediately. But invariably, whatever changes are coming are threadbare discussed in a committee. Now it is the Accolade Committee, which is there for the LODR, and we have the PMAC Committee for the ICDR, etc. They are discussed there, and then it is considered by SEBI board, and then a concept paper is released, and based on that, whatever response is received, let me also tell you, because I've worked with SEBI very closely, the comments are discussed threadbare in a committee, and before they are formally taken on record, and then finally this is being released. So Madam Shailashri Bhaskar has been a member of that committee, and she is really gets to have things up to date, and she has great amount of respect from the officials in SEBI, and I'm extremely pleased that I could be here to partake in this program and give my opening remark. I wish you all happy learning. Over to you.
Thank you so much, sir, for your opening remarks and setting the tone of the session. Now I would like to formally welcome CS Shailashri Bhaskar in this fifth EEE 6.0 Master Knowledge Series webinar. She is a commerce graduate, MBA from Madurai Kamaraj University, and a fellow member of Institute of Company Secretaries of India. She started her career with a private merchant banker in year 1990 and later joined SEBI as an officer. Then in 2002, she started her own practice. She is also a regular faculty at the various programs and seminars organized by ICSI, National Stock Exchange, and National Institute of Security Markets. She was an expert member of Regulatory Oversight Committee and the Settlement Guarantee Fund Committee of the Metropolitan Clearing Corporation of India Limited. Ma'am, we welcome you in this fifth session, and I'm sure that your deliberations today will not enhance our understanding, but also equip us with the actionable insights to contribute effectively to the deeper understanding of the topic. I encourage all the members, participants to actively engage in the session, share their queries, and make the most of this knowledge sharing platform. With these words, I will once again welcome you all and look forward for an insightful and enriching session. Thank you. Thank you so much, ma'am. Over to you.
Thank you. Thank you for this fine introduction and the honor of, being introduced by Mr. Narasimha sir, who is, my role model and mentor. And I look up to him for many of the guidances and encouraging words. And it was such a pleasure to have him by surprise and to introduce me as well. So let's dive deep into the topic and the session today. And let's start. I'm sharing my screen first.
Yes, ma'am.
Is my screen visible?
Yes, ma'am. It's visible.
So the topic that has been given or that we are going to discuss today is the SEBI regulations with focus on the recent amendments. So now SEBI regulations itself is a vast subject. There are so many regulations. And just to rattle off a few, you can think of LODR, PIT, SAST, ICDR, then you have on the funds, AIF, PMS, you have investment advisor, research analyst, so many regulations. So, but then I thought we would just restrict ourselves to three regulations with which we are interacting almost regularly on a daily basis. One would, of course, be the LODR, the Listing Obligations and Disclosure Regulations of 2015, then the Prohibition of Insider Trading Regulations of 2015, and the SEBI ICDR Regulations of 2018. And again, recent amendments. Now, as Narasimhan sir was saying in his introductory words, the number of amendments that have been coming out recently in the last 2 years has been restricted to two a year. Earlier on, it used to be almost one every month. So now we see changes or amendments only to about twice in a year. So, but however, the number of amendments that have come have been very minute and quite a few in the year 2025 and also in the year 2024. So I thought we would keep this time frame to about 2 years. Maybe the earliest one was somewhere in May 2024. So major amendments were made in May 2024. So we'll cut off from say May or June of 2024 onwards up to April of 2026. So some amendments of May are also being covered. Some very minute and very only consequential changes might be ignored in the presentation. But otherwise, all other changes that have taken place after that are included. And you can send in all your queries. We'll handle them separately at the end of the session. So now under the LODR regulations, the various topics that I am going to look into are compliance officer, disclosures. Now, these disclosures are not the Reg 30 disclosures. Reg 30 will be handled separately. Just disclosures because now you're having integrated filing and some disclosures having been done away with. So I thought we should have some discussion about that. The evergreen related party transaction, which never ends, which keeps on, cropping up, and we have more doubts at the end of every session. Then, clarity. Many a times it always happens that we have more questions than answers in related party. So that has to form a part of any seminar, any webinar, any discussion, anything that goes on. Reclassification of promoters, which has undergone some major changes. Secretarial audit and secretarial auditor. Now, audit I will not be covering, but while discussing about secretarial auditor, I would also like to discuss what SEBI and the other regulatory authorities are looking for when you give your annual secretarial compliance report. Then, of course, the Reg 30 disclosures, which has undergone certain significant changes with regard to what are the events for which disclosures have to be made and what are the events for which disclosures need not have to be made, or what should be the threshold limits. And of course, there's a carve out for high value debt listed entities, which we call as HVDLE, and certain other consequential changes. So let's take up LODR straight away. So the first one is about the compliance officer. So you would be appreciating that the company secretary is considered as or is the compliance officer of a company. So now, can the basic query or the basic question that will come is, should the company secretary be the compliance officer, or we can have two company secretaries? One as the company secretary of the company, the other is the compliance officer of the company. So the choice is yours. You can have two. The only condition being compliance officer shall be a qualified company secretary. So you would see in smaller companies, company secretary is always the compliance officer. While in large companies, particularly in public sector undertakings, you might see two persons, one who will act as the company secretary of the company and the other who would be the compliance officer of the company. But whatever it is, the requirement is that the person who is identified and appointed as the compliance officer of the company shall be only a qualified company secretary. It means that anybody who has any other degree, a CA, an MBA, or CWA, or what you name it, an LLB, LLM, whatever it is, cannot be appointed as a compliance officer of the company. So that's the first thing. Second important thing is this compliance officer is also designated as a KMP. So in case a company has two CSs, that is the CS of the company and the compliance officer who's, another CS who's acting as the compliance officer, who's appointed as a compliance officer, both of them will be treated as the KMPs of the company. The CS being the KMP, already identified as KMP under the Companies Act, and the compliance officer also shall be treated as a KMP. The compliance officer shall be in permanent employment, full-time employment of the company. That means no person can name lend and say that I will be the compliance officer or come on a contract basis or be, hired out. But, many times some companies actually have an agreement wherein they take employees from that other company on a contract basis, and then they pay that so many employees we have hired, this is the amount that we are paying. No, this compliance officer cannot be taken on hire like that, must be on the rolls of this company and should be at one level below the board, which means that he or she directly reports to the managing director or to the whole-time director, and in case you don't have either of them, to the CEO of the company. In case the compliance officer vacates, meaning that is he resigns or there is a vacancy, it shall be filled up no later than 3 months from the date of the creation of that vacancy. But most importantly, if you are appointing anybody else in the interim to fill up the vacancy, such a person shall also meet all the requirements as specified under Regulation 6 of the LODR. In other words, the person who is stepping in shall be a qualified company secretary, shall be in full-time employment, should be should be called as a KMP, and so on and so forth. So you cannot bring in somebody who's the MD of the company just to act as a compliance officer for the interim period that they are looking out to appoint a compliance officer. So that should be very, very clear. And any vacancy that arises, because of when the company is under a resolution plan under Section 31 of the IBC, then this can be filled up within a period of 3 years from the date of receipt of approval of the resolution plan. So this is as far as compliance officer is concerned. So since most of the time it's the company secretary who is the compliance officer, it is we who have to take this position with a lot of pride and a lot of responsibility, because being a compliance officer comes, it might be a place of position, but it also is a position with a lot of responsibilities and something that we cannot just take very, very lightly. We must be aware of all the provisions and all the requirements under the various regulations of SEBI and the other applicable acts as well. Second topic that I would like to take up is disclosures. Now, with regard to disclosures, before we actually get into disclosures per se, one of the major amendments that was made by SEBI is with regard to the applicability of the provisions of market capitalization. You must be aware that SEBI regulation says in several places, top 100 companies, top 500, top 1,000, top 2,000. And there are requirements to be complied with by the top 100, top 500, top 1,000, top 2,000, and so on and so forth. Now, how do we determine who are the top 1,000, who are the top, where do I fall? Where does my company fall under? Am I in the top 100 or am I in the top 200, top 500, top 1,000? So earlier, there used to be the list which used to be downloaded as on March 31st every year, because that was the end of the financial year. And then basis where this company stood, whether it was in the top 2,000 or 1,000, then the provisions that were applicable to these entities would become applicable from April 1st. What was the flip side or the effect of such a thing? Your list itself is going to come to you on April 1st. And applicability is on April 1st. So let's say one of the applicability is appointment of woman independent director. Now it becomes applicable from April 1st. And if I don't have a woman independent director on April 1st, I am subject to a fine for non-compliance from that day onwards. Now, it's practically not possible for a company to comply from day one. When you see the list on April 1st, I'd say maybe 8 o'clock, 7 o'clock, 9 o'clock in the morning, and comply with the requirements on April 1st would become very difficult. So what would we do in those days was that we would take the list as on December 31st itself. And in case we are somewhere near, we would try to get ready to comply with the requirements from the 1st of April. So in order to make this doable, in order to make it practical, the committee which Mr. Narasimhan sir was referring to, we actually deliberated, and one of the recommendations, and it has come out as a change to the regulation itself, is that the list is drawn out on December 31st. And basis where the companies are, the requirement will kick in from the 1st of April or the immediate next financial year, whichever is later. Now, suppose the next financial year for this entity is, let us say, January 1st. Suppose this company is going to do from January 1st to 31st. Now, if you are to look at the list on 31st, again from January 1st, it would not be easy to comply. So they would comply from April 1st. For all other entities which are following April to March financial year, you automatically start complying with from April 1st. So you have this 3 months time to prepare, to put in necessary systems in place, to ensure compliance smoothly without having to not comply with any of the requirements from day one. So that is how this came in, and this has been in place for the last 1 year. Now, I think this is the second year that it is in effect. And this requirement, now let's assume the next question is, I am there in this list in the year ending March 31st, or say December 31st, 2024. So for year 25-26, I have complied. Now, as on December 31st, 2025, my company's name is not in the list. So what do? I continue to comply and will stop complying with the requirements only if I am out of this list for 3 consecutive financial years. That is, as on December 31st, for 3 years, I should not figure in the list. And if I don't figure, only then I will stop complying with the requirements. Otherwise, if I'm out for 1 year, but I'm back again for another year, I can keep continuing to comply with the requirements as specified. So this is not only for disclosures, it is for every single requirement, like, constitution of the board, for the constitution of the RMC. Then what about having your meeting? It is AGM before by August instead of September. So whatever it says, top 1,000, top 2,000, whatever be the requirements will all be applicable basis this criteria. Of course, this is one very simple thing that that has been done away with in the regulations. One is disclosure under 7.3, which merely said that we are having that certificate from the compliance officer that we have an RTA, and all the complaints and all the share transfers are being handled in-house, or it is being handled by an RTA and so on. So that has been done away with, because now everything is in demat form. We are moving towards 100% dematerialization, and so therefore the significance of a certificate under regulation 7.3 is lost its meaning, and so therefore regulation 7.3 disclosure has been done away with. Same thing with regulation 43, where we needed a PCS certificate. For that, all transfers have taken place on time. Again, since everything is in demat form and transfers happen online, and we are moving towards 100% dematerialization. Many companies you will see have almost touched 95, 94. Very few companies are there which have very huge physical share certificate presence. And when we have done away with physical transfers, and so many regulatory changes have been done, brought in by SEBI, even this certificate does not have any meaning. So hence, 7.3 and 43 have been done away with. I think last year was the first year. This year will be the second year where it has been done away. Now we move on to a very big change that has come, that is called as integrated filing. So what is integrated filing? What is the significance? What are the benefits that have been derived by integrated filing? All of you all must have been, been handling or grappling with the problem when you are listed on 2 exchanges, both exchanges, NSE and BSE. And let's say you have to file your financial results within 30 minutes, or you have to file, certain compliance reports, CG reports So many things. What you do, you file in one exchange, then you have to file in another exchange. Sometimes there is a time constraint. Sometimes, system hangs. And duplication of work. The format in one exchange was different. The format in the other exchange was slightly different. So, somewhere you miss something, then there was a problem. So because of all these teething troubles and problems that were being faced. So one of the biggest revolutionary measure that has been taken by the SEBI in consultation with both the exchanges, NSE and BSE, who put in the necessary software in place, is that you do the filing called as integrated filing in one platform. And that in turn will disseminate to both the exchanges, BSE as well as NSE. So you can choose which one you want to send it to, but ultimately it goes on to both the exchanges. And to begin with, they have brought in Regulation 13.3, the corporate governance report under Regulation 27, the financial results under Regulation 33, and the statement of deviation and variation under Regulation 32, and the RPT disclosure, that is the report that is given under Regulation 23.9 under integrated filing system for the time being. And the time frame has also been changed for all this. Instead of 21st of the month following the quarter, 21st day of the month following the quarter, they moved all these filings to the year end. That is to the month end, 30th April. However, I still know that many of the filings, you do it in XBRL as well as you also still do it in PDF. And so there is some duplication. And sometimes when there is a filing which is required to be done in XBRL but has been done only in PDF, you are being subject to certain fines because it has not been done, or vice versa. So these are teething troubles which will vanish shortly, and everything will be shifted to XBRL form to the integrated platform. In fact, Reg 30 is moving completely into integrated filing, and I think it's already in place. Most of it is gone into integrated filing, and it's only thing which will probably remain in both PDF as well as in XBRL could be our financial results, because since we have to give the report, the financial results within 30 minutes, it might be difficult to fill in all the details in XBRL within 30 minutes of the conclusion of the meeting. So there we might just do the quick result filing in a PDF form and then give the detailed results using XBRL under the Regulation 30 in the integrated filing platform. So this has in fact made life very simple for many of the company secretaries, and therefore it is a very big step that has been taken by the regulators. So this is the second aspect of regarding disclosures. So there are no other major changes in the disclosures. Of course, it's still an evolving regulation. So there could be more changes with regard to what disclosures to make, how much of a disclosure to make, when not to make, how much not to make, etc., going forward, which we will catch up later on in some other session. But at the moment, the burning topic, which is related party transactions. Now here, I thought, instead of only concentrating on the amendments over the last 2 years, let me bring in the provisions with regard to the related party transactions and with emphasis on the amendments, so that we are very clear as to why these amendments came, how will they be impacting, and so on, instead of only merely focusing on the amendment alone, which will not make much of a sense. So although it might be a repetition, you might have listened to this from several other speakers. You just have to bear it with me as well, because I thought just speaking about amendments will be just talking in the air and it will not make any sense to the listener. So first and foremost is, who is a related party? So I'm going to look at it only from the LODR perspective. So from the LODR perspective, a related party is a person or is an entity which is as defined as a related party under Section 2, subsection 76 of the Companies Act of 2013. As defined as a related party under the Indian Accounting Standards, that is Ind AS, and any person who forms part of the promoter and promoter group of the listed entity, and any person or entity which is holding more than 10% of the paid up capital of the company, either directly or through some other beneficial interest, that is through indirect means. They continue to exert or hold more than 10% of the paid up capital of the company. Now, how do we look into this as this thing? How do we determine? So we have to look into the definition under Companies Act, we list out who are all these people, A, B, C, D, E, and we list all those persons who are related parties under the Ind AS. So they may be A, B, C, maybe D and E are not there, then you like F, G, H. Then promoter and promoter group. Now, promoter and promoter group is as defined in the ICDR. So as per ICDR, promoter is somebody that is identified by the company. So I determine A, B, and C as my promoters. But promoter group is as per definition. So therefore, once I've identified A, B, and C as my promoters, then my promoter group will be those persons in relation to A, in relation to B, in relation to C. So the immediate relatives, holding company, in case it's an entity, holding company, subsidiary, any other entity in which this entity holds more than 20%, this entity, any other entity which holds more than 20% here, and all that permutations, combinations, everything you will have to list down, and then it might be a long list, but then all those people form your related parties. And finally, any person who is holding more than 10% of the paid up capital of the company. I know it was earlier 20%, but since 2023, it has become 10% because SEBI is of the opinion that anybody who's holding more than 10% of the paid up capital of the company will exert significant influence over the affairs of the company. And so therefore, any entity which is holding more than 10% will have to be treated as a related party. Of course, some exemptions are carved out for this 10%, but overall 10% is considered to be the benchmark. So once you have drawn up a list under these 4 parameters, now all those persons who fit in to all these 4 will be the related party. So they will be your universe. So, and therefore, any transaction with this universe, which involves a transfer of resource, service, or obligation from the listed entity or a subsidiary of the listed entity will be treated as a related party transaction. Or further, let's say it is from a subsidiary or from the listed entity on one hand, but to some other person. It is not to the related party, but it is to somebody else. But then the transaction is going to benefit these related parties whom you have listed. Then also it will be treated as a related party transaction. So when SEBI has defined related party transaction, it has kept every single transaction as an RPT, irrespective of whether it is done on arm's length basis, whether it is an ordinary course of business, you name it, it is considering it as a related party transaction. However, certain exemptions were already carved out before 2 years. But in the last 2 years, some more additions have been made. So, but for the benefit of the listeners, I'm just telling you what are all the exemptions. Any preferential allotment will not be treated as a related party transaction. So, any preferential allotment, even though it is made to a promoter or a member of the promoter group, there is no worry. It will be treated as an exempted category and will not be considered as a related party transaction. Any corporate action which benefits all the shareholders, which would mean payment of dividend, then a rights issue of shares, there is a buyback, or there's a delisting, where everybody, all the shareholders are going to get benefited. It is not that one section is, a bonus issue. So like it is not that only one section of only the promoter or one related party or a few related parties are going to get this. All the shareholders are going to benefit from this corporate action. So it will not be treated as a related party transaction. Now let's assume that in our company, there is a bank which is having some shares and the company is opening a savings account or a fixed deposit account with that particular bank. Then in that case, now that bank cannot be treated as your related party just because that bank is holding more than 10% or there is some, relationship. So opening of any fixed deposit, savings account, current account will not be treated as a related party transaction. Fourth exemption that was carved out, that is very major exemption that was carved out in December of 25 or something it was communicated. December of 24 it was communicated, was retail purchases. So what do we mean by retail purchases? Now, retail purchases would mean, let us say, this a particular company is, let's say, making pressure cookers, or it is having a retail store. And there, in that, the director or the KMP or the SMP, they are buying certain items, let's say from the retail store, or they are buying, say, pressure cookers from their own company, or let's say any other, like, they are having a holiday resort. And these people during the vacation with their family are using the holiday resort, and they are using it at the same price or at the discounted price that is given to all the customers. So there is no difference in the pricing, and it is at the discount mechanism or anything else. No beneficial treatment is being given to these people. It is at the same price, but it is bought at their own store. Then in that case, it cannot be treated as a related party transaction, just because, let's say, as a CS of my company, I buy from my own fashion outlet, or I buy pressure cookers from my own company if it's manufacturing pressure cookers, or I buy cars if I'm working for a car manufacturing company, or I use the holiday home if I'm in the holiday home business. So it essentially, these kind of retail purchases are exempted and will not be treated as a related party transaction. So these two extra carve-outs, that is opening of these fixed deposit accounts and current accounts, and these retail purchases were provided as exempted categories in the last 2 years, while the other two were already there. They were made just 1 year before that. So in all, these are the certain exemptions, and we look forward to SEBI to give more such exemptions, because it is, all that which does not exclusively benefit only the promoter or the promoter group or the KMP or the director should definitely not be treated as a related party, because the compliance requirement is huge. And once you keep away all these transactions, reporting, because there are two things. One is the disclosure under 23(9), and the second one is the approval and other things. So even though these exemptions are carved out, even now disclosure is mandated for some of the transactions under 23(9). And so we look forward to SEBI even doing away with the requirement of disclosures under 23(9) going forward. So now, how do you deal with these related party transactions? I'm sure all of you all must be so thorough with this, because we have been talking about this for the last 10 years and continuously talking about it even today. But just even then, because it's one of the most important segments in the entire LODR. So all of the companies which will draw up a policy on related party transactions called as the RPT policy, which will have to specifically say what do they mean by material related party transactions, what are they, and what are the thresholds for determining which is a material related party transaction. Now, of course, SEBI in the most recent amendments has introduced a Schedule 12 to the LODR, wherein they have said this is what will be considered material or material RPT, which in case requires a different set of approvals, and not those transactions which are not material will require a different type of treatment or approval. So first of all, you determine what is your material, what is your RPT policy, and also determine what are the thresholds to determine what are the material related party transactions, which SEBI has also given certain guidance in Schedule 12. So you can tweak that and make it stricter, but you cannot ease what is specified in Schedule 12. So mostly companies will be following what is specified in Schedule 12 only and try to bring it into your RPT policy, unless and until you feel that it is better to have a stricter version. Now, one of the important amendments that have been made in the LODR with regard to SMEs, if you will see, Regulations 17 to 27 are not applicable to SME. So they have left it to the Companies Act. That is, SMEs will have to follow what is specified in the Companies Act, except Regulation 23, wherein they say for RPT, you have to have an RPT policy, and all the requirements that are specified will have to be followed. And with regard to materiality threshold for SMEs, all transactions taken together or individually shall not exceed 50 crore rupees or 10% of the consolidated turnover of the listed entity in that financial year to determine materiality. In other words, if the transaction for an SME listed entity exceeds 51 crore during that year, then that would be it will be considered as a material RPT. Suppose, let's say 10% of that is actually, say more than that. If it comes to say 75, but 50 crore is the limit. So we have to take 50 crore as the limit. In case 75, I mean, if 10% of your turnover is, let us say it's 20 or 25, even then we will go to the higher version. We will take only 50 crore as our limit. Then with regard to brand usage, now brand usage will be, this usage of a brand will be considered material if it exceeds 5% of the annual consolidated turnover, which means now your question would be, if the company is using, let's say, a brand which is owned by a related party and they are paying some payment is being made to that related party for the usage of the brand. And so then what happens? And 5% of the annual consolidated turnover, let us say, is about 500 crores. Now, does it eat into my materiality threshold? Let us say my materiality threshold is say 750 crore. And then my brand usage itself comes to 500. Does it eat into my 750? No. This is exclusive of the materiality threshold that is given to you. So it will be 750 plus this 500. Okay, so that is how we have to calculate. It is notwithstanding you use brand usage of up to 5%. If that is in case it exceeds 5%, then that will be considered material. So if it is 500 is the threshold for brand usage, anything beyond 500, you pass it a separate resolution and say that is a material RPT with regard to usage of brand. And then for your normal, regular, other RPTs, see how it is crossing the materiality threshold, and then you do it accordingly. So this is what Schedule 12 says, that in case your consolidated turnover is up to 20,000, then your threshold is 10% of the annual consolidated turnover. If it is between 20,000 and 40,000, obviously 10% of 20,000 is 2,000. So 2,000 plus 5% of this excess between 20,000 and 40,000, or whatever, be the excess. So suppose you are, let's say, at 22,000. So 2,000 plus 5% of another 2,000 would be what you will be looking at. If it is more than 40,000, obviously if they are saying 3,000, we give you 3,000 crore plus 2.5% of the consolidated turnover above 40,000 crore, or 5,000 crores, whichever is lower, is what will be the threshold limit. So every year you will have to look at your annual consolidated turnover as on March 31st. You will have to calculate what is the threshold limit, and then accordingly find out if the transactions that are proposed to be entered into will be crossing the materiality threshold. At this point, I would like to say, now I want to refer to this case of the SAT order in Linde, where you will appreciate that SAT had clearly ruled. SAT, then Supreme Court, actually it was SEBI, then SAT, then Supreme Court, where Supreme Court's order finally said that the transaction with all the transactions with one single entity is clubbed together to determine your threshold limit. So you cannot break up a particular, what you can say. Let's say I have a related party called A and I have 5 different transactions with them. I cannot say I have 5. Now my threshold limit is 1,000 crore. So I have one transaction with A for 600, another for 500, another for 800. And so therefore I am below the threshold of 1,000. No. Everything is added. Now 600 plus 700 plus 500, I've crossed 1,000. So I need to pass or follow the necessary procedures that have been laid down for materiality threshold. So therefore, it is not related party specific. It is transaction specific. So you will have to, it is related party specific and not transaction specific. So you have to add up all the transactions with the particular related party to determine if you're crossing the threshold limit or not. So the first requirement is, of course, all RPTs, including the material modifications to them, will have to have the prior approval of the audit committee. I think earlier the word prior was not added to this particular thing, and so the word prior assumes great importance, which means that if we do not have the approval of the audit committee before we enter into an RPT, that RPT is voidable at the option of the audit committee, which I will be taking up a little later, which means that it's actually a violation of the regulations. So all your RPTs will require prior approval of the audit committee. Now, not only the RPT, but also the material modifications to that particular RPT. So what is a material modification? Now that will have to be determined by the audit committee as to what they mean by a material modification. So let's say they say a particular any transaction with plus 10% or plus 20% or plus 30%. They may say that anything that exceeds 20% will need material modification. So there is no specification from SEBI defining what is a material modification, but that it could also, from the audit committee point of view, they could say anything that is 100% of what we have said is a material modification. But what we have seen so far is up to 30% of the original. So suppose the contract value approved is say 1,000 crores, then 30% of that to 300 is material modification, which means that up to 1,300 crore is already approved by the audit committee. Any modification or any change beyond this 1,300 is what will require another approval from audit committee if it is not a material RPT, and if it is a material RPT, that plus 30% beyond that will go to the shareholders for approval. But if the audit committee is saying material modification is equal to 10%, then accordingly your RPT policy would say material modification will be 10% of the value that is approved. And so accordingly, anything that crosses 10% will require an approval from the audit committee. The most second important thing, another modification or amendment that has come is the independent directors shall alone approve the RPTs, which means that if the audit committee comprises of non-independent directors, they shall recuse themselves while there is a debate or discussion that goes on with regard to RPTs. So the responsibility that is cast on the independent directors is huge, and they will take their time and effort in order to clear or pass or approve a related party transaction. So that is why probably today you will see that audit committee meetings are far longer. They take much longer time than before and much longer than even a board meeting, because an RPT to be approved will require a lot of deliberation. And you will appreciate another thing that has come in the recent past is the information that is to be placed before the audit committee members before they approve the related party transaction. As per the industry standard forum, the amount of information that goes is huge. And sometimes the agenda papers run to hundreds of pages because there are many related party transactions. And the information that goes with each of these transactions is also so much that every audit independent director has to read these things thoroughly before they actually approve the related party transaction. And so another important thing is, in case the subsidiary is a party to the related party transaction, but it is not the listed entity, then prior approval for transactions exceeding 1 crore will be required if it exceeds 10% of the annual standalone turnover of that subsidiary, or the threshold for material related party transaction of the listed entity. Now, here they have said exceeding 1 crore. So let's assume that the related party transaction here is for 50 lakhs. Now, since the threshold is already given at as 1 crore, you do not need any approval for this transaction. Anything, even though it may hit 10% of the standalone turnover of the subsidiary, or it may cross the materiality threshold for that listed entity. But since that 1 crore is specified, that is an automatic exemption that has been provided in the regulation itself. So the thumb rule is therefore where subsidiary and the related party are entering into a transaction which listed entity is not a party, if the transaction exceeds 1 crore, and also 10%, that is, it's more than 1 crore, and then thereafter exceeds 10% of the annual standalone turnover or this materiality thresholds, then only you will have to apply all these requirements of prior approval of audit committee and going to the shareholders for their approval. What has been exempted is all remuneration and sitting fees that is payable to directors, KMPs and SMPs, except what is paid to the members of the promoter group and promoters will not require any approval from audit committee and also from the shareholders. Let's say we are all human beings. We do forget sometimes to get approval for an RPT. Or, very recent case, what happened was they had taken approval for 100 crores. And because of the increased prices due to the current war situation, the transaction exceeded 100 and it actually went up to 200 and some crores. Or say, it went up to 100 and 180, 200 crore. So which meant that it is beyond the reasons. It is beyond the control of the company because it was because of the war that the prices had gone up tremendously. And because prices had gone up, the transactions had to be entered into. There was no doubt about it. And their essential business model itself was based on the RPT structure that main consumer of their product itself is a related party. And so they have to sell it and the price, because of the price, the value exceeded. So in such a case, what do we do? So the regulation, therefore, has provided an exemption, which came up very, very recently, and saying that within 3 months or in the next audit committee, you can get these RPTs ratified, subject to the fact that the value does not exceed 1 crore and the transaction is not material. And also the rationale for not seeking the approval before and now seeking a ratification should be clearly stated before the audit committee members and should be specified by the audit committee in its approval note and in the minutes while recording the minutes of that particular meeting. Now, in case the audit committee in its wisdom decides not to ratify this particular transaction because they feel that it could have been taken, the prior approval could have been taken, but it has not been done. It is voidable at the option of the audit committee. So let me give you a very fine example of this. Let us say the company was planning to buy some machinery and they have taken approval for, let's say, 150 crore. But then the machinery costed about 200 crores. And they have gone ahead and they have purchased the machinery, installed the machinery as well. Then ratification up to 1 crore is available, but they have spent another extra 49 crore. Now it cannot be ratified as per these. But machinery is already installed. Now you cannot pull out the machinery as well. So what do we do in this case? Now the transaction is voidable at the option of the audit committee. Audit committee in its wisdom could say, now, since this transaction has been entered into without the prior approval of the audit committee, the machinery can either be pulled up and sent back to the vendor, which is impossible, which is very difficult, or the persons who have taken this decision must indemnify the company for this amount. So the audit committee is free to take any kind of a decision. And since the whole thing rests with the independent directors, the risks involved is very huge. So therefore, even for that 1 crore, they have the freedom not to ratify that transaction if they feel that even granting that 1 crore ratification is not in the best interest of the company. So it is voidable at the option of the audit committee. So if the transaction is not entered into, the machinery has not come, they may just pass and take a decision saying that please cancel this contract. We will not go ahead. You take proper approval, do it properly, and then enter into a contract afresh. Or they may just say, ask the persons who are responsible for this to indemnify the company for entering into a contract without proper prior approval. With regard to omnibus approval, so the Companies Act provides omnibus approvals, wherein for those transactions which you are not very clear about, you do not know how frequently you are going to enter into this transaction, what is the exact value at which you are going to enter into, how many items are you going to buy. So the specifics of the contract are not clear. It is very general in nature. In such a case, the regulations also provide that the audit committee can give an omnibus approval, saying that you can enter into a transaction with this particular party for an amount not exceeding 1 crore for this, let us say, for the purchase of stationery. Okay, or for the purpose of hiring of cars. So let's say we have one related party, three different transactions with that particular related party. One might be we buy stationery items like pens, pencils, paper, and so on and so forth. Or then secondly, we may also, they may also be having a what you say, they may be also hiring cars, or they may be just getting into the hiring of cars business. We, in case of an exigency, when our regular person who's supplying cars on hire is not available, we may look into this related party for car. So that be a second type of a transaction. So each of this we can say up to 1 crore of rupees we will give approval is what the audit committee will give. But the condition that they will say is that why are you taking an omnibus should be justified. That is justifiable. So they need to get this justification clearly from the company secretary and the management while putting it up to them for approval. And the audit committee will review what are the actual RPTs that have been entered into under this bus of omnibus transaction, under this umbrella of omnibus transaction. So while giving an omnibus, now let's say they have given for 1 crore. How much has been used during the quarter? If it is only 10 lakhs, for what purpose, why, when, etc., will be considered by the audit committee. Then material RPTs and any material modifications to this will of course require the prior approval of the shareholders. This is also the change that is being brought in, prior approval, which means that we cannot take an approval later. Approvals have to be obtained before the company enters into the RPT. Now, another change that has been brought in very recently is the use of the word omnibus approval granted by the shareholder. Which what they mean is that any approval that has been granted, that is not the omnibus approval which we are talking about, which is given by the audit committee, capping it at 1 crore. What they say is those approvals which are granted for a long period of time. That is, for transactions which, like they say you enter into this transaction with the entity, and there is no validity period that is attached to such resolution from the shareholder. So in such a case, like the approval will be lasting for 10 years, 5 years, with no change in terms, nothing, with one resolution which we probably passed in 2014 or 2015, we will be entering into a transaction in 2027 as. So to cap that is what they have said, that the validity of the approval will be from one AGM to the next AGM. And in case you're taking the approval in a meeting which is other than an AGM, it will be for a period of 1 year from the date of approval. Now, the question that will arise here is, in case it's a project which we are doing, the project itself stretches to say 5 years. And we have taken an approval from the shareholders for this particular project. Let's say we have a software company in our as a subsidiary or as a group entity, and we are having a contract with that group entity for installing necessary software or making necessary changes in our software, and this project may extend to a period of 2 years or 3 years. In that scenario, that we must say that this particular project for which the approval is being taken will extend to so and so, and so then this approval will be valid for the entirety of the project. But if we just enter into a resolution which says that all transactions of this A, B, C, D, E, F, G, H nature to be entered into with my related parties X, Y, Z, P, Q, R, S, and those to be incorporated tomorrow, those to be incorporated next year, those which will be incorporated in 10 years down the line, will no longer hold any validity, because these transactions are specific transactions which you buy, you finish, and one resolution will not help us through this continuously forever and ever and ever. So we have to enter this validity is only from AGM to AGM or from 1 year to the next year from that date of approval. So this is how this has to be looked into, and this is the change that has been brought in very, very recently, I think December of 2025. And report, that is the CG report, the RPT report at 23/9, which goes on a half-yearly basis, which I know is asking for so much of information, even about transactions for which approvals are not taken are also filled up over there. It runs into several pages. It is in the integrated filing format today. And it is a very time consuming affair, but at the moment we have to give it. And as I already said, how does the audit committee consider? It is based the information that is is required to be provided as specified by the ISF, the Industry Standards Forum, which is also very humongous and a lot of voluminous amount of information. So with one RPT, we move on to this reclassification of promoters, where also major changes have been made. Now it has been very much simplified. So the process has been reversed, unlike the past, where earlier we used to take approval from the shareholders and then go to the stock exchange for their approval. So now what we do is we get the request letter from the promoter or the member of the promoter group who wants to reclassify as a public, and the request is considered by the board. They give their views and immediately thereafter submit the application to the stock exchange. In case you have two stock exchanges, both the exchanges on which you are listed, and then one of them will be the nodal, and the other exchange will jointly give the approval with this exchange itself. And once the approval comes from the stock exchange, then within a month you are supposed to call for the approval of the shareholders by way of a general meeting. And in that, you have to get this approved by way of an ordinary resolution and file the copy of that ordinary resolution to the stock exchange. And the stock exchange in turn will give you the NOC. Then it is only a formality. So basically, the whole process has been changed. Earlier, we used to wait. We used to pass the shareholder resolution. Then it used to go to the stock exchange. Stock exchange used to take a lot of time. Approvals may not come. So there was a lot of effort, and sometimes it will be a lot of back and forth. So that has been completely simplified. And also stock exchanges are now time bound to revert on the application, and reclassification is happening on a very quick basis now. One thing you remember, in case there is an open offer, then the reclassification of the acquirer to the promoter category is automatic. There is no need to pass any resolution or anything. You just have to, it is automatically done. Just inform the stock exchange. But the only condition is that this person intends to classify as a promoter shall be specified in the open offer document. That is a letter of offer that is issued in the open offer. But the promoters who are going to be reclassified as part of public post the open offer will have to follow the procedure that is laid down in Regulation 31A. There is no escape for them. And for those promoters who are holding less than 1%, that is persons who are in the promoter group but holding less than 1%, or because of a divorce, some promoters have to be removed from the promoter group. Now, they don't have to go to the shareholders for approval. All they need to do is send in the request, and the board will consider the request, and it will be sent to the exchange. And the moment the exchange grants the NOC or the approval, it is final. The persons who are holding less than 1%, or the persons who are, it's pursuant to a divorce that they seek this reclassification, will automatically get reclassified. That second step of going to the shareholders is no longer required. Then any person who is in the public category but wants to classify themselves as a promoter because of an acquisition of shares or because of transmission from a promoter will have to do so only after making an open offer. Of course, when the person gets shares subsequent or consequent to a transmission, automatically from a promoter, automatically the person gets classified as a promoter, and then we'll have to follow the necessary steps specified for reclassification back to the public category. So they have to meet the conditions of holding less than 10%, not be a KMP, and all those, not exercise control, etc., and not be classified as willful defaulter. All those things will be applicable, but then they automatically get classified as a promoter in case their shares are transmitted to them from a. But any other public person sitting in the public category who will like to classify themselves as a promoter will have to necessarily, compulsorily do so only after making a proposal. Now coming to secretarial auditor, which is one of another big change. We are already used to this. This was, and I think most of those who are practicing might have been already appointed as a secretarial auditor and taken benefit of this amendment, that you will have to be appointed for a period of 5 years and it is beginning from April 2025. So if it's an individual, it is for one term of 5 years. If it is a firm, then it shall be for 2 terms. And that particular secretarial auditor must hold a peer review certificate is a must. So this is a very big change, and again casts a lot of responsibility on the secretarial auditor. And so that's why this slide I thought is more important than even the previous slide, because that previous one, every one of us is aware. It is an amendment which is more than a year old now, and many of us would have been. But there is a report called as the Annual Secretarial Compliance Report, which has to be submitted by May 30 every year. And you look at the format. That format is very, very simple. It hardly says yes, no, have you followed this, have you followed that. But SEBI and the exchanges are not looking at a mere yes, no as a response. They would expect the secretarial auditor to actually check every single compliance under the various provisions of the NODR, right from the appointment of the compliance officer to the preservation of documents and the policies with regard to that. So they would expect us to check whether we have a policy and whether the documents that are prescribed in that policy are being preserved along with an archival policy, and then whether there is a vacancy and the vacancy is being filled up within 3 months. How are the RPTs looked at, whether the calculation is being done, whether any ratification has happened, what about the Reg 30 disclosures that are being done, whether any physical share transfers have taken place, any fines. All these items have to be checked individually. Now, this is only what I'm talking about is only LODR. They expect the secretarial auditor to check also the provisions under the PIT, and if the shareholder, that is the employees benefit scheme, that is SBEB, is applicable, then check under the SBEB. If you are a listed entity and the entity is holding shares in another listed entity, whether the SAST is being complied with. If there is a preferential allotment, whether the provisions, the ICDR have been complied with. If there has been a rights issue, whether that provision has been complied with. All these are something that they are expecting the auditor to check. So although the format looks very simple as an yes, no, before you click an yes or a no or an NA, not applicable, please ensure that all the basic checks have been done before the option has been chosen. So with regard to Reg 30 disclosure, another very important regulation that is there in the LODR. So only one big change that has happened is the bringing in of the materiality threshold. Now you will be aware, or you must all be sure, by now all of us are very thorough. Schedule 3 has a Part A, Para A, and a Part A, Para B. Now Part A is a no-brainer. They have clearly said these are the events. If these events occur, make the disclosure. They've also gone to the extent of saying these are the items that have to be disclosed. So suppose there is an acquisition, then this is what you disclose. If there is a fraud, this is what you disclose. If there's a change in the MOA, this is what you disclose. So they're very, very clear saying that if it's a Para A, this is what it is, this is what you disclose. Now, when it comes to Para B, we were always under the, that freedom, that discretion was given. It was not like Para A, which was prescriptive in nature. Para B was discretionary in nature. Only if the company thought that this was material, it would impact their operations in a material way. Only then we will make a disclosure under Para B, that is Regulation 30 disclosure. Now, suddenly what happened is they said, no, there is no point in being, discretionary here. Let us become prescriptive here also. So they said one teaspoon of medicine in the morning, 1 teaspoon in the afternoon, 1 teaspoon in the evening. So you have to, again, every event that takes place, which are described in Para B, to determine if it is material or not, you have to run it through this threshold. That is where it exceeds 2% of the turnover, or 2% of the net worth, or 2% of the average absolute value of the PAT for the last 3 years. So what you have to do is on April 1st every year, you will have to take out your consolidated financial statements, which you will have, and you will have to determine what is your 2% as on that date. Now, the financial statements may not be ready, so it will get ready by the end of April, say. So you have to determine 2% of the turnover, 2% of the net worth, Then see your PAT for the last 3 years. That is, if it is now we are in 26. So 24, 25, 26, 24, 25, 23, 24. 3 years absolute average. And then the least of the three will be the one which will determine what is your threshold. So if this particular event is of a value which is exceeding any of the least of these three thresholds, then in that case, we have to make a disclosure under Regulation 30. Now, in case the last one, or let us say any of them, that is the net worth is negative, but the other two are positive, then obviously there is no threshold. Anything that happens will become material in nature. That is how we are supposed to look at it. So if in of the 5% of the absolute value for 3 years, 1 year is negative and the other 2 years are positive, then accordingly, this is the absolute value. So you have to take an average, even taking the negative value into consideration. So if you have a 0 or a negative in your one of your responses, then obviously materiality threshold itself goes to 0. There is no threshold in that case. Another important, but however, a very big change and a real ease of doing business was the timing of the disclosure. So earlier on, irrespective of when the meeting was conducted, disclosure had to be made within 30 minutes of the conclusion of the meeting. Now there are many companies which are listed across, across various exchanges, and sometimes some other exchanges open while Indian exchanges are closed. So the impact could happen in another exchange while it may not be captured here. And there are certain other reasons why it is important that it cannot be disclosed, or the meeting may take place. Sometimes the promoters may be located, or the directors may be located in other time zones, so the meeting may actually happen after our stock exchange closes. So in such a case, you are given the discretion. What it says is, in case the meeting concludes after 3 hours, that is up to 3 hours from the closure of the market, then you will have to give within 30 minutes. But if it happens after 3 hours after the closure of the market hours in our domain, then you should give the disclosure within 3 hours of the closure of the board meeting. Suppose you are considering financial results, let's say, and board meeting over 2 days, and the meeting happens over there's a spillover and the meeting happens over 2 days, then the financial result, the outcome, will be given after the conclusion of the meeting on the last day. That is the day on which the meeting concludes. Within 30 minutes of that conclusion will be the time when you will actually give the disclosure. Now, in case there is an event which emanates from the listed entity, and then in that case, you get 12 hours time to give the disclosure about that particular event. But if that event is emanated from outside and the information has come to you because of what we have read in a newspaper or something else, then in that case, we get 24 hours to make a disclosure to the stock exchange. That is because of an event that has not happened within the entity, but outside. But then let's say if there is some information with regard to a tax litigation or a dispute or anything about which we are maintaining all the details in the structured digital database as mandated by the PIT regulation, then the time frame that is allowed is 72 hours for the disclosure. So unlike, when earlier it used to say at the earliest, but not later than 24 hours or within 30 minutes and so on, now we have quite a bit of time. So for financial results, outcome of board meeting, timing available is 30 minutes to 3 hours. While for the other items, if it is within, it is 12, it is outside, it is 24, and it is any other litigation or any other matter which has been entered in SDD, you are having up to 72. So there is some ease that has happened with regard to disclosure. Now, even going to the minute details of some changes in para A and para B. In para A, one item that has been included is with regard to initiation of forensic audit. So you have to give 2 times disclosure, one when it is initiated and one finally when the report is made available as to who initiated it, what is the reason, what is the reason why it was initiated, what are the findings, and whether, along with the comments of the management on the report that is given. Another important thing, big change that happened is when there was any litigation, any fine that was imposed by any statutory authority, even if it was a 10 rupee fine, there was a requirement that it had to be disclosed. And so we could see, the exchange was flooded with that kind of disclosure. So there has been a threshold that has been included that if it is less than 1 lakh, then don't need to disclose. You can give it in your corporate governance report that you will be filing. That is a 27 report, which is 27 report under regulation 27 on CG, which will give the details of the fine, which is very comprehensive. I was looking at the CG reports that have come under the integrated filing now. Very, very comprehensive, capturing all kinds of information. And so that one, and that report actually will be doing away with most of the other disclosures that will be required going forward, because everything is captured there itself. So maybe we would end up in a time where only one disclosure will go at the end of the day. There will not be a shareholding pattern. There will not be a 13.3. There will not be, something under regulation 76 of the DP and so on and so forth. Everything might get captured under one report only. And that is how this CG report was looking at, like it is so very comprehensive. So any penalty which is less than 1 lakh is captured there. And only anything which is more than 1 lakh, I know is very, very small, but still a good beginning, will alone have to be disclosed within 24 hours. Now, the other small changes that have been made is any change in the office of the CEO, managing director, whole-time director, CFO, etc., will have to be done with not later than 3 months from the creation of the vacancy. But if that vacancy, filling up that vacancy requires an approval from the regulatory body, like for example, a company which is in the media, like for example, Raj Telefilms or Z. Suppose they want to appoint somebody, they need to get a clearance from the Ministry of INB. So in that case, the approval takes long time. So for them, 6 months from the date of vacancy is what is provided, and no appointment in the interim will also be required in such a case. Now, any vacancy that arises when, when the IBC, when a resolution plan is being filed, companies under an IBC process, then you don't have to appoint until such time the resolution plan is approved, but somebody else will be identified as the person who will be the full-time key management personnel for ensuring all compliances during that period. Then in case you are appointing any new director or reappointing any director, approval from the shareholders will have to be taken within the next 3 months, or in another general meeting, whichever is earlier. Yeah, you will have to finish off. You cannot wait until the AGM, which might take place much later. And as always, any vacancy in the office of a director or anything cannot be filled up beyond a period of 3 months. And in case you need any approval from a regulatory, government, or a statutory body for the filling up of any director in the company, then the time taken for getting that approval will not be considered. So the moment the approval comes, you will have to immediately appoint that person within 3 months, or a general meeting, whichever is earlier. And if any expiry, any vacancy arises because of expiry of the term of that particular director, then on that date, that vacancy should be filled up. You cannot wait, for 3 months, etc., to fill up that vacancy. Now, all board meetings now only 2 working days prior notices to be given, including for financial results. For record date, it is 3 working days prior notice. Gap between 2 record dates shall not be more than 5. Shall not be less than, more than 5 working days. Then hard copies of annual reports need not have to. You can actually give a letter to the shareholders, provide the link. They can scan the link and they can download the hard copy if they want to. So, but if still a request is made, then you can oblige, but then the regulation now only says that you give them the link and let them scan it and read that link. And in all the KMPs, directors, promoter group, now if they are dealing with any, they are handling any matter which may be price sensitive or which may have a negative impact on the company's operations, or they feel they are in possession of anything, or they are doing any activity which is relevant, which is necessary for the company, for the listed entity to comply with the laws, it is their obligation, their responsibility to inform the listed entity. This was specifically brought in because the CS was held responsible for any non-compliance, and CS was in no way aware of what the particular KMP or that particular director or that particular promoter was in possession of. And so therefore, it was important that, that responsibility was passed on to that particular person, and the CS was not held responsible for the lapse by those particular entities. Then there is a may clause that is optional. So between 1,000 and 2,000 entities can appoint a woman independent director. They can also form a risk management committee. Now, material subsidiary, there was some confusion. In some places, they were the term that was turnover. I think it was more like LODR was using the term turnover, while ICDR was using the term net worth. So, in order to bring it in parity, they said, and some services entities would not have turnover, they would have only net worth. So, in order to ensure parity, now it says 10% of the consolidated turnover or net worth, whichever is applicable. And then where a non-NED is attaining the age of 75, then approval is required for continuing that person as the NED, but that approval should be prior. That means the moment the person finishes 74th birthday in the AGM, it is important to get the approval done and not wait for that person to finish 75 and go to the next AGM. And these board meetings, audit committee meetings, etc., it was saying 4 times in a year. So they have made it very clear it is 4 times in a financial year. The word financial has been added in the recent amendments in order to bring this clarity so that there's no confusion. It is not calendar year or from one meeting to another year on year. It is 4 times in a financial year. Stakeholder relationship committee will meet at least once a year. The risk management committee will meet at least twice a year. Now, high value debt listed entity is a separate set. There are entities where the NCDs are more than 1,000 crores. So a separate carve out has been given called as Chapter 5A, which talks about what are the various conditions that are applicable to them, which is exactly in line with the CG provisions as specified in Regulation 17 to 27, which earlier was saying applicable to equity and to HVDLE, but now they have carved it out. But some places, there are certain mismatches between what is specified in 5A and what is specified under 17. So I think there are certain teething troubles, some cut and paste errors, which SEBI will sort out going forward. But essentially, it talks about composition of the board, which is the same as what is there for equity listed entity. Then how NED attaining 75 years of age should have prior approval. Then approval for an appointment of a director in the next EGM or not the vacancy not being more than 3 months. Then any continuation of any director approval at least once every 5 years. Then what about how quickly do you fill vacancy, the office of a director? Then what about the frequency of meetings? What about quorum? How many directors can they hold? What about the various committees that have to be constituted? Vigil mechanism, RPT, secretarial audit, everything ditto. So although there is a carve out, I thought there's no point in going in detail into all this because it's just exactly a replica of what is specified there. Of course, with some small mismatches between what is in that chapter and this. Unfortunately, in the chapter from 17 to 27, the exemption is already being provided to HVDLE, while here it says that these provisions are applicable. I think going forward, SEBI will correct those anomalies. Oh, this should have been a previous slide. So this is where the RMC should have met twice in a year, and approval of shareholders for remuneration that is payable to the managing director. In case it exceeds 50% of the total remuneration that is payable, you should take the approval of shareholders by way of a special resolution every year. And for every item, special item that is specified in the notice, you have to annex the rationale as to why you are going for that particular item of business in the explanatory statement. So with that, we kind of conclude LODR, although I think LODR can go on and on and on. But I thought we should also focus on these other 2 regulations. One is PIT, the other is ICD. Now, PIT has seen some major changes in December of 2025 and also in June of 2025. But I would concentrate more on the major changes, not into the minute ones, which of course we can always handle, very easily. Major thing has been the definition section. It brought in some new terminologies and which were never there earlier, and also tried to link all these people to the act of insider trading. One is connected person. Now, in connected person, only cosmetic changes have been made. The definition still remains the same. in the sense that the period of 6 months before the act is remaining the same. And it is again only, it is, whether you're fiduciary relationship, whether you're contractual relationship, whether you're an officer, whether you're a KMP, promoter, director, by employment, or it is by virtue of just the relationship. And there is a frequent communication between the person who is who is in this contractual relationship or in this employment relationship, and the person who's handling that UPSI. And there has actually been an exchange of UPSI, or there are reasonable circumstances to show that there has been exchange of UPSI. So the idea is the same, except that some a, some and, some word here and some word there has been added to give more clarity to that definition. Otherwise, there is no big change to the word connected person. However, the definition deemed to be connected has been tweaked. In that, they have brought in that relative of a connected person shall be deemed to be a connected person. Now, the term relative has never been used in any of the regulations of SEBI. Wherever you see, even ICDR talks about relative, it also talks about immediate relative, and SAST has always been about immediate relative. Now, for the first time in PIT, the term relative is used. And the term relative used in PIT is not the term relative used in under the Companies Act, because in some other regulation where they are using the term relative, they say relative shall be as defined under the Companies Act. But here, the relative term is defined slightly differently. So we will come to that little later in the next slide. But then a relative of the connected person is deemed to be a connected person. Remember, always a spouse of the connected person, of the insider, is always deemed to be possession of UPS. There is no exemption at all. Everything applies. But still, a relative of the connected person is deemed to be connected. Then a firm, its partner, its employee, in which a connected person is a partner, will also be deemed to be connected. So if there is a connected person X, and this connected person X is a partner of a partnership firm, then the other partners, the other employees of that firm were all deemed to be connected, which is quite scary. Then if you have same household address, so suppose, let's say, there is a connected person and their address is, let's say, A101, some building, etc. Now, if that household or that residence is also shared by somebody else, that person also shall be deemed to be a connected person. So at this point, when I was reading this change, I was reminded of one of the adjudication orders where it was Rasi Electrodes, where this company was run by three brothers, and one of the brothers, the eldest brother, had broken up. He had separated from the other two brothers and was staying separately with his wife. Now, the address for all the three brothers were the same. That is, it had the same building name. Now, therefore, SEBI actually said that they are in possession. Now, this lady, the eldest brother's wife, had traded in the shares when the financial results were being considered, or some UPSI was floating around. And SEBI said that she had indulged in insider trading. Now, she moved the SAT against the order, and 2 points that were placed by her before the SAT was one, that she was not staying in the same address, although it is having the same house number. There are two separate houses within the same compound. And although they meet during social functions, they are not staying in the same address. That was one. Secondly, she had also put in the trading pattern. She said that if you look at the trading pattern, it is not, her buy was always at a time when results were already known, or so this UPSI was known, or at the highest price, and it was not at the most advantageous price. So both these points were put across by her before the SAT. And SAT said, just because the person is in the same address, because they are two different buildings, they shall not be treated as being connected. And also the trading pattern very clearly brings out that there is no exchange of UPSI and shall not, therefore this order will be set aside. This is that in another presentation, AO had actually said that there is no insider trading and had imposed zero penalty in another show cause notice as well. Now, looking at this particular definition, Now, it may be very difficult for an AO to pass such an order, because once they say you're sharing a household or a residence, it will be very difficult to prove that you are no longer a connected person. Now, coming to generally available information, now one carve out has been given. They say that in case it's an unverified event or an information which is emanating in the print media or electronic media, that is social forms, it will not be considered as generally available. It is somebody who's simply floating a rumor. So we don't have to worry about it. So relative here they have defined shall mean the spouse of the person, parent of the person and parent of the spouse, sibling of the person and sibling of the spouse, child of the person, child of the spouse, spouse of the person listed in two above. So which would mean that, it's already, in three above, siblings. So it would mean the spouse of the siblings will also be considered as a relative, and spouse of the children would also be considered as relatives. So this is different from what is there in the Companies Act. They're not talking about stepchildren, no stepson, no stepbrothers, nothing. Sibling will always automatically mean only biological. Whether it also includes step is a question mark. It's not clear. So this is something we'd have to be deliberated upon, but this is what the definition is. And all these people will therefore be considered as connected person. So under UPSI, award or termination of contract, not in the normal course of business, has now been considered as UPSI, which was anyway expected to do so, because there were several orders which were passed by SAT, wherein these kind of contracts, I think Suzlon was one of it, where SAT considered it as UPSI and accordingly proceeded to uphold AO orders basis that presumption. Any change in the KMP, which is other than superannuation, any change in secretarial auditor, any change in statutory auditor are also considered as UPSI. One important change, of course, apart from the definitions that has happened, is the tweaking of the trading plan. You must all be aware that although trading plan is a facility that is available, many of them companies are not making use of the trading plan because it was always said that it was not being very beneficial. So now they say you cannot entail commencement once you give your trading plan. Now it is only 120 days, which means more or less reduced to 4 months instead of the earlier 6 months. And now the parameters have to be clearly laid down when you give the trading plan. That is the value of the trade, or the nature, whether it's buy or sell, then the date or the dates when you want to execute, and also the price range, which is voluntary. And one trading plan shall not overlap another trading plan, but all other restrictive clauses that were there have all been removed. Trading plan, no trading window restrictions. So if you're given a trading plan, you can continue to trade. So therefore, the time frame, all those restrictions which were there, which meant that you were able to trade only for a very short period of time when you are given a trading plan, is no longer there. So more flexibility is available. So the discovery of the price that the person wants with these restrictions is more possible now. Units of mutual fund have also been brought in. That is one of the major this thing. And in case of any information that is not emanating from the company but from outside, which could probably be UPSI, the company need not be in a hurry and close the trading window. Those trading window restrictions are not applicable, and SEBI will take it into account. So these are some of the major changes in PIT. And otherwise, PIT as such is a separate big regulation. Separate session should be held, and we cannot cover it in 1.5 hours. Also, with all the various case laws and the way the nuances of PIT will be an exclusive session by itself. ICDR, why I thought we should touch this, is now fundraising is become simple because of the right issue process. The timelines have been fast tracked. No longer do you have to go to SEBI. Stock exchange is the nodal authority for granting the approval. So the moment the board clears the right issue, you file your letter of offer, draft letter of offer with the exchange. And the document is no longer a 300 or a 350 page document. It's a very simple document, limited disclosure only. Concentration is essentially only on the objects of the issue. Even litigation chapter, which used to run several pages earlier, not required. Financials, sometimes we used to restate, etc., not required. Only links to be kept. And then they have to just go, web links are provided. You go to the web and then you see what is given there. So risk factor objects is the only crucial chapters as far as the document is concerned. There is nothing else. And the whole exercise can get completed within 23 working days. Max to max 30 working days, your right issue will be over. Merchant banker appointment not mandatory. SEBI clearance is not required. Only required. Monitoring agency has become mandatory for all right issues. And now they have brought in one more important facility called as specific investors, wherein in case the promoter is not able to subscribe to their rights entitlement, then they can identify a specific investor and say that the promoter will renounce their entire holding in favor of the specific investor, which means that your issue gets subscribed with the subscription from the specific investor. Only requirement being the specific investor must subscribe on day one of the right issue, and confirmation should go to the exchange before 11:30 a.m. on day one. Otherwise, there is nothing else. So instead of doing a pref allotment, we can do a right issue with a specific investor, which means that you are completing your right issue very smoothly, and the offer is being made to all the shareholders of the company. So in case promoter doesn't have money, they can get in the subscription from the specific investor, and even then minimum subscription clause is not applicable. So this is a very good alternative methodology. And I've seen in the last 1 year since this simplified process has come, many companies have been tapping the right issues process as a route to actually go ahead to raise funds. Another important area where change has come is the IPOs with regard to SMEs. Now, SMEs, there was a time when there were a lot of SMEs which were filing documents. Even today, you can see there are a lot of SMEs where the actual manufacturing, the brick and mortar is taking place in the SME sector. But the compliances there are not very strong. They're weak because they have been essentially run as family-run organizations. But with the government push for the SME, and the regulations also being made in such a way that they can tap the market, the disclosures have been tightened. So the DRHP or the RHP has disclosures which are almost on par with that of an IPO on the main board segment. So which means that all of you people who are company secretaries of SMEs, please ensure that your minutes, that your maintenance of filing of forms and everything is perfect. It is in accordance with SS1, with the secretarial standards. Because I remember once I was attending one of the sessions, and one of the speakers said that why should SS be applicable to private limited companies? He said because for them compliance is taken very lightly. And I have now come across many companies, SMEs, which were private limited, which are now trying to tap the SME market. And the compliance is so poor that many a times minutes are not properly drafted, resolutions are not properly drafted, forms are not filed on time, or the forms are filled up in such a haphazard manner that the dates, the meetings that are mentioned there do not match with the meetings that are mentioned in the minutes book. The MGT7 speaks about minutes on XYZ dates, while the minutes is talking about minutes on ABC dates. So, it is therefore the merchant banker also finds it very difficult to do the due diligence because exchanges are not going to let them off lightly. Their diligence gets into a little bit of a mess. So as CSS, it is very important that compliance even of the private limited companies that you're handling, or companies which are unlisted but which are SMEs and likely to go for IPOs. Anyway, they will go for IPO anytime shortly, over a period of time. Your compliances are up to the moment. Because you remember, there is a repository that is created. Many documents are put in the repository, and if there is a mismatch, the document gets rejected by the exchange. The exchange also checks it on the MCA website, and if they find mismatches, the document gets rejected. And monitoring agency has become compulsory for all issue sizes above 50 crore for an SME. And GCP has been capped at 10 crore rupees or 15% of the issue size, whichever is lower. So most of the time it is at 10 crore only. And there are certain other changes that have been made, which are not very relevant, which merchant banker will take care, but these two have to be taken care. That is your compliances. So with that, I think I'll stop. I'll open the floor for questions so that we can have more interactive. We can have a more interactive session. Thank you so much.
Thank you so much, ma'am, for this detailed presentation and detailed deliberation. We
Thank
are
you.
already receiving so much of appreciation for this session and the deliberations that we have in this 1.5 hour. We have so many questions, but all the questions I think been answered in upcoming slides there. So it's really, really engaging and interesting to know the SEBI LODR in this way so that it can be little non-technical as well as non-complex. So thank you
Thank
so
you so
much,
much.
ma'am, first of all. And now I would like to take some of the questions that we have received from the members. So one of first question I would like to take is, as per the recent amendment regarding the lock-in of securities, where depositories mark them as non-transferable instead of maintaining lock-in, is it mandatory for a company planning an IPO to amend its article of association to include such provisions?
No. Company is going for IPO, so therefore the shares will be under lock-in.
Yes.
It will be as per the ICDR. No, what is the point in amending the articles? See,
They are like they need to amend their articles of association to include such provisions regarding the lock-in thing.
no, not required, because this lock-in comes in from the ICDR regulations. As per the ICDR regulations, the minimum 20% of the shares that are held by the promoters will have to be given up for lock-in. Okay. So, what are those shares is to be decided by the promoters only. There is earlier on, I remember when ICDR was notified. At that point in time, it will be like what has come in last will have to be locked in, and everybody used to scramble there to ensure that this was taken at the lowest price and some other thing was taken at a higher price and so on and so forth. Now nothing. The regulation is very clear. You give whatever shares you feel like giving to the for lock-in. And also, if the promoter does not have enough shares, there are other opportunities or there are facilities that are available. You can take it from some other, PE investor who will give it to you. A lot of other facilities have opened up under ICDR. So there is no requirement for any amendment in the articles which will enable you to give your shares for lock-in. Lock-in is something that is to be is on the shares that are held by the promoter per se, and it is not on the shares that are issued by the company. So therefore, there is no need for any amendment from the company perspective.
Okay.
And the depository will ensure that lock-in is inscripted in that particular demat account.
Okay. Another question we have is for a private limited debt listed company, will PIT regulations be applicable? Does company need to comply with the closing of trading window and SDD?
See, the PIT regulations say that it is applicable to all listed entities, including units of mutual funds. So there they say it is applicable to all securities. Now, what are securities? Securities are what is defined under the SCR. SCRA read with SCRR. And in that, NCD is defined as a security. So therefore, PIT regulations are applicable. Now, coming to the second part of the question, whether I have to close the trading window. It is now, if suppose you have issued NCDs on a, let's say as a public issue, and you are having 2,000 debenture holders, trading window will obviously have an impact over there. Suppose you are an HPDLE and you have only 2 debenture holders, then maybe a trading window may not have much of an impact. But then the regulations are applicable. You apply, and what impact it will have is left to our imagination.
Okay. Whether listed entity need to give minimum standard information to its audit committee and shareholders on material related party transaction. If the listed entity is exempted to comply with the regulation 23 of SEBI LODR, as it falls under regulation 15 subsection 2 SEBI LODR.
Now, let me put it this way. See, 23(5) gives certain transactions as exempted, number one. That is, if the transaction is between a wholly owned subsidiary and this thing, it's exempted. Between two public sector companies, it's exempted. So, and between a government company and a public sector undertaking, it is exempted. Any payment of statutory dues, like, income tax dues, this, that, etc., etc. They have listed certain things, those are exempt. Now, they've also listed certain like SMEs, now it is covered. So SMEs no longer exempted. But then if you are under IBC, I think some exemptions are there, some are not there exempt. So now, as for your question is whether I should get pre-clearance for all these this. Now, for all these exempted transactions, once they are exempted, obviously none of the provisions are applicable. But if they are not exempted, then it squarely gets covered and you have to necessarily take prior approval of the audit committee. Now, again, exemption also, if you see, there are two types of exemptions that are given. One is exemption from approval, another is exemption from disclosure under the 23(9). So although certain transactions are exempted from prior approval, no material, because they are, even if they are material, no need to go to shareholders, but disclosures might be required to be given. So we have to clearly see which bracket we fall under and accordingly take a call whether it is exemption from disclosure or exemption from.
Okay. Another question we have is, in case of SME listed company, is there any requirement to submit PCS certificate for paid up capital or net worth?
What is this certificate for? Because there are so many certificates that are required. So the question is incomplete. Paid up capital and net worth in what context?
Yes, that is not being mentioned by the members. So yes.
Yeah. So if it is for IC, for filing of DRHP, yes, it is required.
Another question we have is, in a financial year 25-26, a secretarial auditor appointed in PSU, it's an unlisted public limited company through GEM bidding for the period of 5 years. Just before the AGM, agenda is not taken to the AGM. Company is listed after 6 months for appointment in financial year 25-26. Now, what is the implication of Regulation 24A of LODR? Shareholder
Yeah,
will
this is a common query that everybody is asking. So let me put it like this. So now, as per the LODR, every listed entity now will have to appoint a secretarial auditor who is approved by the shareholders of the company. Now, when is the LODR applicable? LODR is applicable only after you become listed. Till that time, LODR is not applicable to you. So now let's say this company has already appointed a secretarial auditor for 5 years in an EGM of its company before it became listed. Now the shareholders who are coming in after listing are entirely different. So there is one viewpoint that say anyway that person has been appointed for 5 years by the shareholders who might be 7 or 8 at that point in time. So that person will continue. But there is also another viewpoint which says, no, the shareholders are different. Now there are set of public shareholders. You will have to place this resolution once again. So far, we have not seen any reaction from SEBI or from exchange on this. And so there is a gap between ICDR and LODR on this perspective. So at the moment, what companies are doing, they do all these appointments before the company gets listed. They continue with this arrangement even after it is listed. Nobody has raised an objection. So please continue with it till such time somebody raises an objection.
Okay, ma'am. Another question, in integrated filing XBRL, we are given 24 hours to submit the file. However, for integrated half-yearly filing, Regulation 23(9), related party transaction is required
Has to be immediate
on the same day the board meeting concludes. So please confirm whether these two timelines conflict with each other.
No, they don't conflict. I'll tell you where they are coming from. The financial results will have to be filed within 30 minutes of the conclusion of the board meeting, which is approving the results. So now that does not go in XBRL. That goes in PDF because the number of lines and extra, the XBRL is too long and lengthy. You cannot finish it in half an hour. Okay, you have got only 30 minutes. Now the RPT 23(9) also has to go on the same day. Now that has to go in XBRL. Whereas the detailed results which you submit in XBRL happens the next day. You get one more day. So these are the 3 timelines that are applicable. And I know 23(9), we really don't, because it is pages. Sometimes it is, I heard it is 1,000 lines also of information many a times. So it is always, I hope to God that everything is in order. That's it. So all the 3 timelines are fine. We leave it at that.
Another question is, in case of a listed entity, how to determine that any person, entity holding more than 10% of the paid up capital of the company, either directly or indirectly, or through beneficial interest at any time during the previous financial year?
Benpos.
Okay.
So you get your Benpos every week. So CS is required to see who are all the people who are holding more than 10%.
Ma'am, kindly clarify, even if any RPT is exempted under Section 188, audit committee prior approval is required?
That's what I told you as far as LODR is concerned. It does not look into a transaction as arm's length, ordinary course of business, etc. All these terminologies which are used in the Companies Act. So therefore, any RPT for a listed entity will require prior approval of the auditor. And if it is a material related party transaction, prior approval of the shareholders.
Ma'am, if Regulation 23 is not applicable on an entity because of Regulation 15, then is it mandatory for an entity to give details of RPT transaction in XBRL? And entity is within the threshold limit with respect to paid up capital and net worth.
Now, I think we have to look at 2-3 things over here. Now when we go to that chapter, so there are companies equity listed entities is what Regulation 15 is. Now, in case the entire CG provisions are not applicable, which means net worth of 25 and paid up capital of 10 crores. So one of the two, this thing is not met. Then at that time, even this Regulation 23 is not applicable to them. So they can just comply with what is specified under the Companies Act. But if it's an SME, even though their net worth or paid up capital will not be this, 23(9) alone is applicable. That is only that report has to be filed. And of course, they have to meet with all the other requirements as specified. That is, they have to take prior approval of audit committee. They have to do this. So for SME, this exemption is not there. While a small company on the main board, it is exempt. That is the dichotomy in the regulation. And only, debt listed, HVDLE, it is applicable. But when it's not an HVDLE, it's not applicable. So you have, everywhere, wherever, you have to draw the table. You have to say, is it applicable? If this section is not applicable, nothing is applicable. I'm out. But if it's applicable, yes, everything is applicable.
So basically, one thing is applicable, everything is applicable. If one thing is not applicable, everything is not
Nothing is applicable. That's how you have to do this litmus test. So you have to draw a table, put it. If yes, this is yes, then everything falls in. No, nothing. The whole thing goes out.
Ma'am, can a RPT with a director for taking loan from a director, unsecured loan and interest-free loan, can be treated as arm's length and ordinary course of business?
LODR, no arm's length, no ordinary course of business.
It only consider the transaction. If it is a transaction, then it has
only
to be.
Remuneration is exempted, and then all those dividends, etc. That also they have corrected now. Earlier it was only saying dividend, corporate action. So it is corporate action from a listed entity, something like that they have added, so that to say that recipient and the giver both are protected.
Ratification by audit committee is allowable only up to 1 crore. If ratification is more than of rupees 1 crore, whether audit committee can ratify such genuine transaction?
No. Then what happens to the transaction? So that's what we have said, it's voidable. So I gave examples also saying that if machinery is there, they can ask the directors to indemnify. Or if nothing has happened, they say cancel them. So the independent directors on the audit committee have all the power to do what they feel is right.
Okay. So if the transaction is above 1 crore and not ratifiable by the audit committee, then the transaction is voidable.
It's a violation. It's a non-compliance.
Independent director, right?
No, it's a violation of the regulation because there is no provision for ratification. So auditors cannot ratify.
Right. So it has
so
to come
what
into
happens to the
committee.
contract itself is a question.
Under integrated filing, few regulations are applicable on a company, few are not. For example, Regulation 13 is applicable, but Regulation 27 is not. So how to fill the information?
No, that I think the form itself helps you, takes you through. No worries. They made the form very helpful. So 13.3 alone you will file and others will say not applicable and get out of the system.
Okay. if a promoter who was formerly MD of a listed entity till 2022 sends a request for reclassification, but the listed entity refused to do so, or it is not placed before the board within 2 months from the receipt of the letter. Now, what is the course and whether receipt of such letter needs to be reported to the stock exchange?
Receipt, I think, is one of the regulation 30 disclosure, if I'm not mistaken. And once board approves, again it goes under regulation 30. And third is when you file with the exchange. Then fourth stage is when you get the approval from the exchange. And last stage is when you have got the approval from the shareholders. So I think 4 of the 5 items have to be reported under Reg 30. And one of it is receipt of a request from a particular shareholder. So if that is so, if the board did not consider or they considered it, they didn't approve it, considered it but did not approve, even that will have to be a Reg 30 disclosure. So that will have to be taken care. But the MD cannot force the company to accept the request.
What if company is not mentioning the time in regulation 30 disclosure, whether same will be the reason for qualification in secretarial auditor report?
So exchange will catch them immediately. First level will be what exchange will say, why have you not disclosed the time? So there could be a fine because it's an improper disclosure. And then secretarial auditor will report that their fine has been moved.
Okay.
So first level already is there.
While time for submission of results extended from 30 minutes to 3 hours, if meeting concludes after market hours. However, there is an ambiguity whether this also applies to debt listed company. I think this is one of the similar questions. As may secretarial auditor insist for submission within 30 minutes only, as above extension.
I'll tell you why this question has come. This particular provision is there under the equity listing. It is there in Reg 30. While the carve out, Chapter 5A has missed this out. Okay, so when I was discussing 5A, I said there are some anomalies between 5A and the main regulation. Because 5A has come as a carve out. Okay, so what has happened? If you look at only 5A, if I'm an HBDL, then I will look at 5A because that is what is applicable to me. Now 5A says only 30 minutes. It does not talk about this 3 hours, 12 hours, 24 hours, 72 hours, etc. So because of this anomaly, the secretarial auditors rightly pointed out that why you have not done it. So till this anomaly is corrected, you have to go by what 5A says, Chapter 5 says.
Ma'am, whether a person who has approved trading plan is permitted to trade during the period of trading window closure?
Yes, because he has given his trading plan. He says, this is what I intend to do. So everything is out in the open. There is no secret. And normally, when he is in possession of UPSI, we consider that that time is a time when he cannot trade. That is why that 120 days cooling period. So that is the time when he is supposed to be in possession of UPSI and that he has not traded during that period of time. So once the trading plan is given, 120 days cooling period, after which it's all open. They can continue.
Okay. Two trading plan cannot overlap. Overlapping here refers to execution period or cooling off period?
It means both. So let's say I give a trading plan today. Okay, today is what? April 28th. Okay, so now this trading plan will be valid for a year. Now it will expire on April 27, 2027. Now I have to give another trading plan which will run from 27 April of or 28th April of 2027. So I cannot give another plan which will be from 1st April of 2027 to 27, which has that common period. That is what they mean by overlap. Now, when I give that plan, again, I have to go through that 120 days cooling period. Then again, it.
Okay. Is there a need to submit certificate under Regulation 74(5) of Depositories Act when Regulation 49 of the LODR has been deleted?
See, at the moment, 74, 5, 4 and 6, both are there under the Depositories Act. They'll have to take steps to delete it. I think it's in process. You have to wait until it goes. But for the moment, it is there.
Okay. If our company is a listed NBFC and lending is our normal course of business, then we consider it in RPT. Additionally, company covered in Regulation 15. Hence, we are exempted from Regulation 17 to 27. filing, then only disclosures are not allowed or we are exempt from full regulation.
Now let's look at it three-part question. This is a three-part question. First of all, they say they are an NBFC, listed NBFC. So for them, lending is a normal activity. Now, but if they are lending to their director or their KMP, let's say one of their KMPs or one of their SMP is taking loans, it will be similar to retail purchases, which I said is exempted. So you have to look at it from that angle. That is possible. Now, having said that, he also says we are only a debt listed entity. And it's not an HVD, high value, that is HVDL. So this entire provision only is not applicable. So why worry for the time being? Let the other NBFCs who are not debt listed but equity listed, then they have to think about this. But for them, they have to see whether if they give it to a related party, that is, except promoter group, if they give it to the KMP or anything, it could be a retail purchase. So they could get covered under that exemption.
Okay, one of the last question now we are going to have for this session. What are the special rights to the shareholders under Regulation 31B of LODR?
See, that was a new thing that was introduced. So what special rights could be there to a promoter? Maybe, some on voting. Essentially, it will be on voting is what they are looking at, or power to nominate or have a director without without meeting any of the qualification criteria or anything like that. So these are some of the rights that a person could exercise exclusively and to their own benefit. So, and there could be certain understandings that maybe they will use these rights to their advantage, which could act against the interests of the company. And that is why that 31B was introduced, to say that make a disclosure of these rights. But I don't know how many of them, only the very top few companies have actually made these kind of disclosures. To be honest, I have also not really analyzed what are the kind of disclosures that have been made under 31B. But the idea was that they could get extra dividend, or maybe the power to appoint some officers or directors without going through any other normal process. But all that is really not possible today, because if you want to appoint any director, they say take approval once in 5 years. They say remuneration is to a promoter will require approval. So it's little difficult to fathom, but still that regulations.
So thank you so much, ma'am. We are coming to the conclusion of this wonderful session.
I enjoyed it thoroughly. And the last question was the most difficult question. I think I'll also have to do some reference and write back to you.
So thank you so much formally from on behalf of ICSI and the members who have joined in large number to this webinar. And the questions that we have received, I think I'm very new to this SEBI LODR thing. So finally, some of the nitty-gritties I also come to know through this webinar.
Oh, very nice.
So thank you so much, ma'am, for taking your valuable time for us and for the members.
Thank you so much.
Thank you, members, for joining us. Thank you.
Yeah. Bye. Thank you.